Jeff, good to see you. One of your most favorite conversations, am I tax ready for retirement? Taxes don't disappear in retirement as much as we would hope they would. In fact, understanding tax implications becomes even more important. So let's talk through the 4 questions that you should be asking your advisor before retiring. The first question is, how will my tax situation change once I retire?
Right, but just because you retire, you may think that your tax bracket will be lower in retirement, but that may not always be the case. That may not
Mhm.
be what happens in your situation. If we look back historically, tax rates are right now very low compared to where they've been in prior years and prior decades. And there's no guarantee that future tax rates are going to stay where they are as well. 5 or 10 or 15 years from now in retirement, tax rates might be considerably different. And because of all the things that are happening in our country, the huge deficits, uh, tax rates may indeed be increased in the future. So it's important to understand your different sources of retirement income and how they're taxed, whether that's a pension or IRAs or distributions from brokerage accounts, interest and dividends and capital gains or royalties or rental income. All of that needs to be considered for how your taxes are going to come into play in the future.
Mhm. And that leads us nicely into the next question, which is, are there strategies to reduce my tax liability in retirement?
Yeah, absolutely. We talk an awful lot about diversification in your portfolio, reducing the risk by having the right mix of stocks and bonds and strategies to reduce losses in your portfolio.
Mhm.
But we don't talk nearly enough about diversification of the tax allocation. If we look at the different types of strategies, your IRA accounts are going to be fully taxable to you upon distribution. Brokerage accounts, the after tax investments are partially taxable. And then the Roth investments are going to be completely tax free for you in retirement. And so some mix of those is going to be what may make sense for you. And then there's other strategies to consider, things like qualified charitable distributions.
Mhm.
Move money from an IRA straight to your church or charity.
Mhm.
That can make sense. So you completely cut Uncle Sam out of the loop with that. And
Mhm.
we would look at things like itemizing your deductions and bundling up those expenses into certain years to reduce your taxes in certain years as well.
Mhm. And as we talk through those strategies, a lot of people want to know if they should consider a Roth conversion before they stop working.
Right. The Roth conversion is a very hot topic, and
Yeah.
there's no limitation. There, if you've got $1 million in an IRA account, you could convert that full $1 million into a Roth account. It's a completely taxable transaction, though, and you're going to be bumped up into a very, very high tax bracket by doing that. But you can make smaller conversions over the years. And so we would look a lot at what is your current marginal tax rates. Does it make sense to make those conversions while you're still working or after you stop working? If we can convert at a lower tax rate, a 12% rate, then that certainly makes sense to do those conversions now.
Mm. And the last question comes down to your withdrawal strategy. What are the tax implications, you touched on this, of withdrawing from my various accounts?
We want to take a look at, again, the different types of accounts. If you
Mhm.
draw money from the IRA accounts, it's fully taxable as ordinary income, and that can increase the taxation on your Social Security as well. If we look at the brokerage types of accounts, you're going to have some capital gains potentially and interest and dividends along the way, so it's partially taxed. And then the Roth distributions, if we follow the rules and the holding periods, can be completely income tax free. So it depends on what your retirement strategy is going to be. Do you want to leave money for the kids as legacy? And so the Roth accounts are the best money to leave to the kids because they're going to be completely income tax free for them.
Mhm.
If we
Mhm.
want the money to last for as long as possible, it may be some blend of the distributions in order to reduce taxes along the way.
Mhm. I love that you're always thinking about legacy planning as well, Jeff. If people want to know if they are tax ready for retirement, certainly bring this list of questions to your advisor. If he or she can't answer these questions, might be time for a new advisor. But if somebody wants to talk this through with you, Jeff, how can they get a hold of you?
Yep, they can call our office directly. It's 405-681-9633, or they can go to our website, gortonfinancial.com, and we'd be glad to help.
Great. Jeff, thank you.
All right. Thank you, Erin.